Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Happy 6 de Mayo, everyone. It's Peter Dunn, Pete the Planner, CEO of Your Moneyline, here live, 2 p.m. Eastern on a Tuesday. As every Tuesday and Thursday, we have Navigating Now, which was designed to be a
CalmCast.
Right, it's supposed to calm us down during these wild, unpredictable financial times of which we find ourselves, as you know, here's who's here, participants, people covered by Your Moneyline, your employer. You are here. You can always ask us questions, give us a call, go to your account, including our new mobile app. By all means, you can get a hold of us. And for the general public who just happens to tune in because you love it, welcome. All right, let's talk about what we're going to talk about today. There's three main topics. As always, we're talking asset allocation. That's asset allocation, if I wanted to pronounce it the right way the second time I said it. We've got GDP itself. Wow, you want to talk about a concept being on the Mount Rushmore of our economy. We'll talk about GDP. Then, of course, what people think should be on the Mount Rushmore of personal finance, which is your credit score. A lot of Mount Rushmore talk. I'm not surely entirely why I'm doing that, but alas, here we are and we're live. Okay, what's happened since the last time we talked? Markets continue to meander. The volatility is kind of taken out of the market. We had a pretty big win streak. Although today, as we sit here, markets are down pretty substantially. As the markets, again, you kind of personify them, but the markets are waiting on the Federal Reserve Board's decision tomorrow, Wednesday, as to whether they're going to lower interest rates or keep them the same. As you've learned on Navigating Now, this would have an impact on the economy. And I don't like making predictions on this show. Like I'm supposed to teach. This show is about teaching, but I'm going to make a prediction. There's no way the Federal Reserve lowers interest rates at their meeting tomorrow. In fact, I read today there's a 2.7% chance within the betting markets. I love that there are betting markets around what the Federal Reserve is going to do. Anyway, it probably won't happen. Okay? That being said, still lots to sort out with the economy, with tariffs. And one thing to note, there is not yet a tariff deal 1 month and 4 days into the tariff season. We have a tariff season now. There's no trade deals. And so that means we have about 60 days left until some other elements kick in, according to what the Trump administration has said. So we'll see what happens. I will note this before we go much further. This Friday, which is the 9th, I believe, is when, that is correct, the 9th. That is when theoretically, we should actually see the impact of the tariffs on prices. For the most part, we haven't really seen across the board a change in prices of the things we buy because the inventory of those things was already here. It hadn't been tariffed, if you will, hadn't been taxed. That should change starting around Friday. So we'll just keep our eyes out for it. Hey, best case scenario, we never feel it. And we can talk about it and acknowledge it here. Let's talk about asset allocation, your market terminology for the day. Okay. A lot of people think if you're going to do well in the stock market, it's about picking the right stocks, the right individual calls. I think it's this one, or I think it's this one. And that's arguably true. But I would say what is more likely true is that particular stock you chose was a certain type of stock. It was a certain size of company in a certain industry. And so that is to say, those are often called asset classes, large cap growth or large cap value, meaning they're low price, but maybe still deliver some dividends. So that's to say, it's just as important to choose different asset classes that have different risk and reward scenarios to get a good outcome than it is to throw darts at individual stocks. Now, when you're at a cocktail party, by the way, no one goes to cocktail parties. I always love when you talk about investing, you're like, hey, at the next cocktail party you're at, you're not going to cocktail parties. I'm not getting invited, and I probably wouldn't go anyway unless there was adequate parking. Alas, the next time you're at a cocktail party, people start talking about stock picks. shush their lips, like touch their lips and say, shh. It's actually about asset class. It's about asset allocation. You need this type of sized company in this sector and this type of size, not the actual company itself. It's the types. And that is how you round out and make good financial decisions. That's how you can control the amount of risk you're taking versus the amount of reward you're seeking. That being said, as we're going to talk tomorrow when we talk diversification, what would make close to no sense is if all of your holdings were within one asset class, large cap growth or small cap growth or international. That doesn't make a lot of sense because there's not diversification within that asset allocation. Diversification and asset allocation are often confused. Alas, we'll sort that out tomorrow. Okay, let's talk GDP. You hear it all the time. You hear it all the time. On a scale of 1 to 10, 10 being a perfect explanation of what it is, I find most people are around a 6. My goal today is to take you to an 8. Yeah, aiming low. Stands for gross domestic product. You may or may not know that. It is the total value of everything a country produces in a set period of time. It's usually measured by fiscal quarter, meaning January 1st to March 31st. How much did the U.S. economy specifically, as we're talking about our country, how much did it produce, right? And what it tells us is the economy growing? Are we producing more things? Or are we producing less things? And what's interesting about this, when you have a high GDP, when the economy is growing, that means there are going to be more jobs, okay? It also means there's going to be wage growth as people compete to hire you, right? If there's a ton of jobs and you're unemployed and we need you to work for us and because we want you to fill our position as opposed to someone else, we got to pay you more. Okay, so more jobs equal higher pay, then equals more spending, more business investment, these sorts of things, more confidence, and then that's the path we go. Generally speaking, I've just explained what the U.S. economy is. Generally speaking, our gross domestic product grows over time. It's what it does. Occasionally you have down times, and this is called a recession. We're actually going to talk about a recession quite a bit tomorrow, but when the GDP doesn't grow, when the amount of goods produced shrinks, is less than it was the previous quarter, it's called contraction or it's called a recession, and it means there are going to be fewer jobs, fewer pay raises, less spending, less confidence, and here we are. So, as you probably know, the first quarter of 2025, we had a 0.3% contraction or a 30 basis point contraction. That in itself is not ideal, but it's not the end of the world, because for it to actually be a trend, it has to be quarters in a row. So far, we're with one quarter. Why did I hold up a pinky to signify one as opposed to the more orthodox index finger? No one knows. And for those just listening on the podcast, I just made a visual reference. Okay, so that's what you need to know about GDP. That takes you to an 8 out of 10. Speaking of scores, let's talk credit scores. Directionally, it can kind of tell you how you're doing financially. I think it tells you and others how good you are at borrowing money, which maybe you don't want to borrow money, so you don't necessarily feel like you need to be good at borrowing money. But it's an important thing to know. Of course, people covered by your money line, you can use, run your credit score right in our app right there. But it should go along with other concepts that we've even talked about here on Navigating Now, including power percentage. All told, your credit score is above 700, you're probably fine. You're probably fine, right? You're not going to pay increased rates on your auto insurance and those sorts of things, and your homeowner's insurance, because those have insurance scoring components to them, credit scoring components to them. If you're below 700, you're going to pay higher rates on things, and you're going to pay higher rates on your insurance products as well. Anything above 800 is fantastic, but the best way to make sure it doesn't impact you is to not make borrowing a massive part of your life. Here's what we're talking about tomorrow, or by tomorrow, I mean Thursday, on the show: diversification, recession, and a sinking fund. Ooh, that's fun. All right, stay tuned for the Fed's decision tomorrow. If you miss it, I will cover it on Thursday right here on
CalmCast.